to Hi everyone, and welcome along to our Sunday market analysis show for today, the 5th of February 2023. It's great to have your company today. My name is Paul B. I'm the founder of Actions to Wealth, and we have one heck of a show sorted out for you guys today. I think one of the topics that's on everybody's mind as a trader is what's happening with gold. We've seen the big seasonal run up, beautifully picked by Ainslie in our trading retreat in Bali. She literally got us in right at the nice start of that. It's gone up $200 since he put us in a great spot. And then it's pulled back big Thursday, Friday. We're going to hear from Ainslie about her view on gold. Is it going up? Is it going to stop? Before that, we're going to have Ainslie come in and talk to us about oil and what's going on with oil. So we're going to go oil, and then we're going to go gold. And then we're going to have George come in and do his market analysis piece as well. George coming in from Johannesburg in South Africa. Brilliant trader, a detailed guy, an accuracy guy. In fact, today is, if you like, detail and accuracy people. I'm going to ask Ainslie to join me. Ainslie, are you ready to go?
Hi, Paul. How are you?
Ainslie, I'm good. How are you?
Good. How's the weather, Paul?
Oh, look, where I am, it's rainy. To be fair, I'm a long way from the major problems in New Zealand. But yeah, Auckland had 3 months of rain in 4 hours. It wasn't good. And this is the middle of summer. Yeah, so yeah, but where I am, it's just it's a little bit colder and it's rainy, but it's not too bad. How about you? How's Sydney?
Cracking weather today. Nice 30 degrees, sunny, blue skies. I know we weren't saying that last. We certainly weren't saying that last summer, were we?
We'll talk about it in 6 months, eh? We'll see what you're saying in the middle of. We'll see what you're saying in the middle of June, eh? Hey, look, Ainslie, I'm really keen today. Gold's the headline. We'll do gold second, but oil is interesting. You know, for mine, we've still got a lot of stuff going on affecting this market, and clarity and direction hasn't been as clear for me in the last couple of months. I'm really interested in your thoughts on oil and where it's going and what we should be doing with it.
Oil's awful. What can I say? And if I can just share the screen, if I could, Paul, and I'll just pop across to my screen to share. If you just confirm that you can see my
oil analysis, 5th of February. I can see that.
Excellent. Let's have a look. Let's jump into it. So unfortunately, oil closed downward with the trend. It's just downward moving at the moment. I've got the wrong slide up. Hang on, 2 ticks. Yeah, sorry, hang on. I've got the wrong one up. I know, because I had gold sorted out first, Paul. Where are you? Come back to me. Well, I just sort these.
Ainslie?
Yes?
Just for you, if you want to hold on, I'll stop and I'll reintroduce gold and we can do gold, and Sam can cut this out of the recording. So only people live and the people in the room know that we butchered this completely.
I butchered it because we normally do gold first and then we do oil, and then you completely swap me around and I've done the wrong thing. And I've just...
So you want to do gold first?
Let's go to gold because I'm happy.
Look, people at home, let's pretend that we're just starting right now. On YouTube, you're going to see this. On the live stream, you're going to see this, but it'll be cut up and put out later on, different parts. And here's what I'm going to do. I'm going to grab a bit of stuff on me. We're going to, I think we're going to be pinned. Hi, everyone, and welcome along for today, the 5th of February, 2023. Big session today. First up, leading the way, is Ainslie talking about gold. You guys heard me with Ash last week saying that I've been in the seasonal move with gold, that Ainslie put me in the trading retreat in November. I'd come out last week, and this week we've seen it continue to consolidate, and then a couple of big days down. I'm wondering what's going on in the gold market. There's these big decisive bars down. Is this gold move over Ainslie, or is the seasonal move, which has still got a month to go? Is the seasonal move, which still has a month to go, still to play out? Looking forward to getting your analysis and finding out a bit more about it, Ainslie.
Thanks, Paul. So gold. We've had a really good rally, and as quite a few of us have. If you were listening to me off the triple bottom that we identified on the 6th of November, I said it's ready to go. It's ready. It's not going any shorter. It's ready to go. This week we've had a really interesting week. So let's just put the last couple of months aside. But the last couple of weeks, this last week has seen quite a move. First of all, the Fed posted an interest rate increase baked in. We expected it, 25 basis points on Wednesday, and we saw a strong rally, and and gold took off. It peaked out at 1959, which was really nice because I was really looking for a straight up run to 4,000, but I didn't get it because what did we see on Thursday? On Thursday, we had the ECB. Now, the ECB, there was no follow through on that at all. The euro, and let's just remember why, because the euro is a large weighted component of the dollar index. So looking at the dollar index and with no follow through, if you haven't got anything happening on the euro and that's something that would be pushing the US dollar down further, we didn't have that. So the US dollar sort of like went, well, hello, there's something here we can bounce from. We saw a rally, which really, so we saw a rally on the US dollar, which brought gold down. It didn't like that very much at all. It spent a day consolidating, and then we had non-farm payrolls. Now, I've got some really terse words to say about non-farm payrolls, and they're not pleasant and they're not nice. After the ADP unemployment figures that came out Wednesday night, it was 188,000. So no surprise that the forecast for NFPs was 185,000. It came in at 517,000. Unemployment dropped to 3.4%. And that's the lowest rate of unemployment in 60 years. Now, given the backdrop that we've been told about the headwinds and there's a recession looming and all these other things, all these other components that are meant to make gold take off or the dollar drop, had just evaporated in a blink on Friday night. So gold took a bath and it dropped like a stone, and we're talking a major drop. So let's have a look at the charts. That's a monthly chart, which you can see is a fairly significant move so far, but let's go straight down to the weekly. You can see this, it'd been cranking up. There's our triple bottom we initially spoke about from the 6th of November, and we identified that, and it's just gone up and up, very technically based, very technically, and in a very nice, neat seasonal manner. I did expect, you're talking R3 here on the third level of resistance on a monthly pivot. So we are expecting it to, retrace, have a little bit of a hiccup trying to get through there, through retrace, but it didn't. And let's go back down, let's drop down to a daily chart and have a look at these two big bars. So Thursday, ECB news and USD got some really good traction after a very neat little bounce. I mean, if you look at this, we came up, we hit R3 on the monthly pivot, we bounced back down, we bounced off, we have a low test bar. This is a very technical chart, guys. This is a low test bar happening on Friday, Thursday, Tuesday, and off she went. She exceeded and closed above the previous R3, and I thought we're looking pretty good here. Then we had that ECB news on Thursday. We have a huge bearish engulfing candle, and then that nonsense. Call me cynical. We call that nonsense of the NFP going straight back down again. Is it going to stop? Is it going to take a chill here? What's it going to do? I don't know. I think it's going to fall to 1850, which just, personally irks me, but let's be realistic. It's the 50 EMA lining up with the R1 on a monthly chart. So that's a pretty strong level of resistance. Going to the 4-hourly chart, I mean, ouch. That really hurts, doesn't it? It's not what we're looking for. That's not what we're looking for at this time of the year. Seasonality, seasonally, we are expecting a retracement in the first week of February, by the way. So, let's have a look. But for the whole way through this, and if you look at the report, central banks have continued to accumulate gold because of the current economic outlook, all right? So prior to Friday, central banks have been continuing to accumulate gold. They accumulated gold at such a rate at the end of last quarter, Q4 in 2022, it was an unprecedented level because of what they were seeing happening with the US dollar, or what they were forecasting and expected to happen with the US dollar coming into 2023. NFP figures, as I said, and let's just set aside the fact that I think they're rubbish, and let's just go with a slightly more conservative view. They're controversial. They have contained a huge amount of statistically adjusted totals and numbers, and how that's going to play out and how that's going to adjust when people start to sift through, or analysts start to sift through the real numbers and the real components that are making this up. Let's because we need to overlay that in the current situation, the current economic climate. The current economic climate is such that you've got some of the big names that make up the technical part of the NASDAQ and the S&P. You've got your Amazon, you've got your Twitter, you've got your Meta, you've got your every other Apple. You've got those big companies. They're all laying off people. Now, that's not an immediate thing. Not everybody's getting a pink slip on Monday, okay? That will take a little bit of time. That will take a bit of time to sift through. But let's go back to reality. These are numbers that have come through. There is a lagging component that we need to take into account. But the NFP figures, you can't just go from 188,000 to 517,000 jobs created overnight. I just think there will be a big adjustment coming into February and into the following months as well. February's got a lot to go as far as seasonally wise, but we do expect, as I said, seasonality, we do expect to see that retracement in the first week of Feb. The other thing that's coming online as well, we haven't quite seen enough of it, is the Chinese retail demand. Lockdown restrictions, as we know, have been eased, but there's still some other bits and pieces going on in that background. It hasn't come into full production. So what that means is, okay, we've retraced from this beautiful high of 1959. We didn't go straight up to 4,000, which is a real damn shame, to a close of 1864. Where to next is the question. As I said, we've got a component and we've got a certain reality of trying to sift through what those numbers and those statistically adjusted figures are going to represent, and how that is going to come into the real world, and a bit of reality coming into the next coming months. And even though FedPal's comments last Wednesday were expected, and we did get it, and we did have a rally, we just need to see where that goes and how that affects bonds and real yields and inflation. And we need to just take into account, is that a real reflection of unemployment being at its lowest in 60 years? There is a lot there to bring together at the table to see where gold will go to next. All we know is that we've had two really decisive down days, which were ugly, but if you got out at 1950 during the week, you've done exceptionally well if you've been in since November. So yeah, that's where we're at, Paul, with gold, and that's my summary. But looking at where we're going to go to next is a bit of a look. I'm trying to weigh up what we've been told and what we've been fed with reality and what we're looking at.
Is it fair to say that 1850 is going to be crucial? We've got 4-hour S3, daily 50 EMA, horizontal level, and daily 90 support 1, all there, right? So if it closes below that, pretty concerning if it bounces, maybe the game's back on.
Yeah, it's just I don't like it. I don't like it.
No, I'm sure you don't. And it's one of the things about this rally, isn't it? It's been typified by big selling days. It's been a magnificent rally, but there's been a number of decent-sized selling days on the way up. It's not a new part of this rally. So
it does that. And if you look, let's just pop back to there's a daily. There's your 20 EMA. Hello. Bounce there, beautiful bounce. And we all know gold loves levels. It really does. So it wouldn't surprise me if we see it pull back to 1850.
I think that's nearly a certainty for mine, Ainsley. What happens there will be really interesting one, and I really like that. It is really technical, and it really does love levels. And one of the things that does mean is that to some degree, if you've got some knowledge and some skill, you can trade it to levels. because you know it doesn't miss them very often. It doesn't miss them by a little bit. But it really is interesting, isn't it? That first close under the 20 moving average. One of the things that would have happened is that would have cleaned out a lot of stops. There'd have been a bunch of people with stops just sitting underneath that because it's been bouncing off it for so long now, and that would have all been cleaned out and pushed this move down a bit further.
Yeah, and like I said, a lot of those, you've got to take into consideration, a lot of these things, especially with a commodity like gold, you've got a lot of algo trading that just hears those huge numbers, bang, straight down. And if you're watching a chart on Friday night when that number was released, it just dropped like a stone. So, like I said, it will take a bit of time for analysts to actually sift through the information, look at what is happening in the real world and go, oh, hang on, too much. This is just ridiculous. But the other thing is, like I said, you just dig down a little bit further. Central banks are still buying gold. What does that tell you?
We've got to move on to oil, Ainsley, but one thing I do agree with in this, right, is that in this market, right, the professional trading firms have got an analyst, and he said if the numbers above this, we're long, and if the numbers are below, whatever it is, that they'll have a plan going in, right? So they see the numbers, and their traders go bang, but the detail follows. They'll be digging into those numbers now and having a look, but there'll be an initial reaction because that's what a lot of these guys are doing. The algos are doing, and again, we've gone below the 20 for the first time. We've gone below weekly pivot for the first time in weeks, and there'll have been a bunch of stops sitting below both of those things, and now there'll be a lot of stops below this 50 moving average. So if we get a bounce, we'll be good. And if we get through it, going to see where we go. Love the analysis, Ainsley. Hope it's brought some clarity to all you guys listening and watching the recordings of this live later on. It certainly should have brought some clarity to it. Ainsley, if gold's been brilliant, oil's been a bit of a mess. Oil for mine, for me, I always say this, right, that I only trade things I understand. And oil has been off for me for a few months now. I keep looking at it and going, I just don't know why it's not double that price, to be honest. I keep going, why isn't it just go? It's going to go up. So when's it going to go up? Why doesn't it go up? And until it does, I won't trade it. Until it does what I expect it to do, I just sit on the sidelines and wait. What about you? Can you bring some light onto what's going on with the oil?
I wish I could. I really do. It's just been, as I said, it's been a bit rangy and thingy and just awful at the moment. So let me just pull this up, 2 ticks. Make sure I've got the right charts there. Yeah, it's the right chart. Here we go, guys. Sorry about that. All right, so let me share a screen. So what we've got on oil, it's not a lot. It's just range. All it has done is range. And you can see that on the monthly and weekly really, really clearly. If you're looking on the daily and the 4-hourly chart, it looks like it's retraced heavily, but that's only because of the US data. It's nothing to do with the fundamentals that are actually associated with oil. So let's have a look at the weekly and the monthly. Have a look at that. So December bar, December bar was a low test bar, bouncing off the 200 EMA, 200 simple moving average, which was supported by the 50 EMA. Very nice technical setup for me to look for a long. Didn't get it. So what did I get? I got an inside bar in January. Nothing happened. Seasonally, what's meant to happen at the end of January? We're meant to see a really big move because of what's happening with the Northern Hemisphere and demand for oil. Didn't get it. On the daily chart, still going sideways, absolutely sideways. Where we closed on Friday, and that was only and you can see that if I pop down to the daily and the 4-hourly chart, which I'll do next, all you can see here is that you're slowly getting a grind up with lower highs here, lower highs there, and lower highs there. But at the end of the day, you're below the 20 EMA, you are still ranging, and we've been ranging since jolly middle of November. So have we got any direction? No, absolutely none. And to make it worse on the, excuse me, on the monthly, we're still sitting between the 20 EMA, the 200 simple moving average. This 200 simple moving average is flat. We've got the 50 EMA also flat and at the same level as the 200 simple moving average. So really, we've got nothing. And you can see here on the DI plus and the DI minus on the ADX, when they're both pointing down, that's consolidation. So you just, so let's have a look at the 4-hourly and the daily. And we can see, okay, we had two high test bars bouncing off of 50 EMA and down it came. Consolidated, and then that's non-farm payrolls and straight down it came. But when you look at it on the big screen, on the bigger frames, that's where I prefer to trade on large commodities like oil and gold, so I don't get chewed up, is the fact that it is still ranging. Haven't got anything. So trying to dig through and trying to find some fundamentals that can support what's happened. It's not necessarily oil at demand and supply components, guys. It's what's happened in the US, what's happened with interest rates, what's happened with everything else but oil. Because at the meeting, excuse me, sorry guys, I've had COVID and I've got this tickle. Really sorry. OPEC Plus, yeah, I'm okay. OPEC Plus didn't even change their production quotas, completely unchanged. And they've done that based on the fact they're expecting China to get back up and running into full production soon, in inverted commas. Now, that's great, but nothing's changed. So one of the reasons we're ranging, and ranging pathetically, is because nothing's changed. Demands haven't changed. China hasn't increased in demands. The supply hasn't changed. Nothing's changed. So status quo is going to stay the same. What we now have to look at, got the daily bar closed on its low. So we're waiting to see what happens next. So we know that when a big decisive bar closes on its low, it tends to reverse it on the next bar. That is a general rule of thumb, being proven wrong on that on a couple of occasions, but that's just what it is. The other thing that's an interesting component, which will affect, it hasn't come into play yet, is there's a looming EU embargo on Russian oil. So when that comes into play, you start to get the moving parts with the demand and the supply side of things. That should start to see oil move. I want gold to move, by the way, back up again. But oil, yeah, we want to see that starting to move back up in that direction. I don't necessarily want it to move it on a chart. Yes, putting it in petrol in a petrol browser. No, I don't. And the other thing that really needs to start cranking up, and we haven't quite seen it yet, is the Chinese increase in manufacturing. That will also increase demand. So between the Russians and the Chinese, yeah, let's have a look and wait to see there, because at the moment, OPEC from the supply side have changed absolutely nothing. And that's why we're ranging.
We will watch with interest, Ainslie. Thank you very much for that great information and nice and clear as always. Much appreciated for that. Yeah, Catherine just saying residual COVID's no fun. Do hope you recover quickly, Ainslie. It seems to me at the moment that everybody it seems to me at the moment that everybody I know that gets COVID, they're not getting knocked around badly by it, but it's lasting longer. No one's dying of COVID right now. They're not in my world, but people are getting COVID for 2 or 3 weeks instead of 2 or 3 bad days. They get 2 or 3 knocked around for a while. I do hope you get better quickly, Ainslie. I know you're tough. I know you won't be far away from being a lot better. Cheers.
Thanks.
Rightio, next we've got George joining us from South Africa. He'll be a video talking about normally price action and what's going on in the markets this week. George, those who saw him trade in Bali will know, trades a lot of indices. He's a price action trader, very detailed. I'll get Sam to play that video now.
Good day, traders. I trust you're well, and welcome to this talk show, and welcome to the month of February. Today, I thought I'll just spend a few moments sharing with you some common price action patterns that you will come across virtually on every chart, on every time frame, every market. So let's have a look at it. The red line is the low of yesterday. And of course, I am using the 5-minute time frame for illustration. But remember, markets are fractal, so whatever you see on one chart will appear on one time frame will appear on other time frames. Here we had a wedge top and a bear breakout below the low of yesterday after the wedge top. So I'm always looking when I see a pattern, I want to see what's coming after that. So wedge top, I want to see the bear acceleration. So that's pretty good for the bears. Then got to find a way to get into the market. That pullback, so bear breakout, that pullback, that bear candle was the first attempt by the bears to continue with the selling. So that's a low one, call that a low one in terms of price action terms. And what we want is to get a second entry short. So the market needs to be trying to go short for the second time. It's a higher high, which is good because the bulls were strong enough to try and break out above that first attempt. It's a higher high, but it's failed. So higher high that fails and becomes a second entry short is a pretty good trade to take. Because it's a bull candle, of course, you know, it's a lower probability trade, but it's below the low of yesterday or YD is a low of yesterday, and it's below the wedge top. So that would be a pretty good trade. You take that trade, you expect an acceleration down all the way to the bottom of the earth, but we don't get that. We go sideways. Now, I keep saying to guys that there is no noise on the 5-minute time frame. This is information. This tightly useful because it's showing us that the bulls are trying to break out, but they're failing. Micro double top, so that's double top with one candle beneath it. Also a micro wedge, 1, 2, 3. So very strong forces in play here. Then we get an outside candle by the bulls. An outside candle is a trading range candle, and we wait for a failed breakout, which we get failed breakout above the outside candle with this candle and a reversal. So that becomes a much stronger signal to take than even that one. Okay, failed breakout above the tight trading range, and still we're testing the low of yesterday. So whenever you see these tight trading ranges, and you see double tops, micro wedge top in there, then you see the reversal signal. That is a strong trade to take. If you're taking that trade, stop is still above here, above the wedge top. So do not take both trades because then you're just increasing your risk. You have to take one of the trades. So that's a pretty strong one to take. It's a breakout, pullback, higher high, low true test of low of yesterday. It's the first one that we got. Then we had the tight trading range at the EMA and also tight trading range below low of yesterday. Then we have a lower high double top below low of yesterday. So confluence of factors, nested patterns, all confirming bear forces. So second trade you take. If you took that, you just hold on to your trade. No need to exit. And again, you take that, you expect an acceleration. You don't get it, but you get another little tight trading range, and the bears again breaking out beneath that. Then we have bear acceleration. Somewhere within here, the market is going short. So it's always in short. If you haven't taken any of the trades, you got to find ways to get into the market. The only problem is you're going towards the open of the US market. So if you're taking trades, you must keep a wide stop in the market because you might just get a reversal pattern that kicks you out and the market keeps going your way. What we had at the open, pretty common pattern, not at the open, but often anyway throughout the day, expanding triangle. Okay, market is creating an expanding triangle. You can see the triangle there. An expanding triangle is a breakout mode, usually off the high of the expanding triangle, you expect bears to sell off. Off the low of the expanding triangle, we expect bulls to sell off. So here the market tried to break out above this tight trading range and go to the top of this, now it's an expanding triangle, but if you connect that high and that high, it got to that level. So if you're looking to trade here, unless you find a lower entry, a better entry off the 1-minute chart, which sometimes I do, you got to wait for the close of the candle. It comes back to the middle of the trading range and it's a bull candle. So a bit problematic, best to wait for a bear candle. You get a bear candle, and the problem with it is that now we're way deep into the middle of the first candle. That's the first candle for the US session measured move of it is down here, and that's your goal. But bears are selling beneath a bull candle, so low probability trade. You still take it if you want. That's why I put it in gray. It's a low probability trade, but you can take it and manage your trade. Stop up here. You're hoping to get all the way down here, but be aware of the expanding triangle bottom. The bulls could turn the market right there, and you have to get out with a break-even trade. In any case, you were rewarded, and the reward got you to the measured move of the first candle of the New York Stock Exchange Open. That's what I call the US Open. So you'd have to get out there. You know, if you didn't have a profit taken, right there, you must get out above that candle, because bulls are going to be jumping in. And bulls are thinking, well, we had an expanding triangle bottom. We tried to break out beneath it. We failed. Let's take that and see if we're going to test the top of the expanding triangle. It's a low probability trade because you're beneath the moving average. But if this was occurring in another context, you would take that trade. Bulls took it, hoping that to get acceleration up, it failed. And as soon as market turned and did an inside candle, if you're a bull taking that trade, low probability trade, you must exit. Scalpers are always in and out of the market. I prefer for these green entries, so I'd rather wait for that. But in any case, if you're taking that low probability trade, fantastic. When you're taking that as an inside candle, your stop is still way up here. That's where your stop would be. You know, you can't stick your stop in the middle of the trading range. So you got to decide that, why am I taking that low probability? We've got measured moves. Am I going to get there? You don't know. So what the market creates here is pretty common as a pattern, a convergent pattern. Just as we had the expanding triangle as a breakout mode pattern on the extremes, a convergent triangle when the price is converging to one point is also a breakout mode pattern. We expect that any breakout beneath, above or beneath a convergent triangle will fail, and the market likes to come back to the apex. So here the market went up, failed, came down, bears had a follow through, and they failed breakout beneath the convergent triangle. And you could take that as a first trade, low probability trade. Whenever you see a pattern, wait for the second entry. So here is the second entry, a much better, higher probability trade, micro double bottom, breakout, pullback, distant enough reversal candle. When you're taking trades here, you're trading as a reversal trader. You know, that's what I love trading as a reversal trader. If you don't want to trade that, wait for the market to break out, and you say, oh, okay, now we are breaking out and going up to test that. Breakout, you can take, as the market comes above there, you can take that trade. It's a breakout, it's a pullback, it's a high one, first high after the pullback, so you can take that. Then, of course, you want to see the market pattern. Again, low probability trade to take that. Why do you want to take it? Well, it's 10 EMA strongest part of a trend, decent enough reversal candle, but you're going into the low of yesterday. So if you're taking that, drop your risk down to 0.25%. You might just get rewarded and the market goes up, but then also you get this pullback. You don't get stopped out, you know, because when you take that trade, your stop is going to be way down here. That's where the stop is going to be. When the market accelerates up, you can tighten your stop to there and wait. No reason for you to exit. I mean, you took the trade. If you do exit, you can exit before break even, but best to hold on and see what gets. You don't get huge bear candles here. So this is now a higher low double bottom, and you get another higher low double bottom here. There is a lower low double bottom. That low is lower than that, but it's a higher low double bottom. Bad signal for the bulls, and you got to wait because of where we are. But you're still keeping track of what the market has done. Eventually, get an inside candle just above the low of yesterday, worthy to take that, put your stop down here and see how far you go. Eventually get to a measured move of the breakout above that trading range. Now, just a quick recap. So expanding triangle with the US Open. Expanding triangle is breakout mode. We expect the market to reverse at the top or reverse at the bottom. Converging triangle is also breakout mode. We expect any breakout to fail and the market come back to the apex, which it did. Then we have a major trend reversal alert, MTRA, major trend reversal alert, failed breakout below the converging triangle, and then with the micro double bottom, which is a lower low major trend reversal alert. It's an alert that this whole bear trend might reverse. Need a little bit more information. Then you get breakout pullback, higher low, reversing reversal signals, a higher low major trend reversal alert. So you can take that trade. I will take that and put my stop and measured move down here. When you get acceleration up, I can touch my stop today. If you don't want to take reversal trades, there is a trade that will take them up here. We're getting higher low double bottoms, and then inside candle is a bull breakout at low of yesterday. So these patterns do occur sometime during the day in different charts, and I hope you found it useful. Thank you very much, and we will see you Wednesdays live trading profits, 15-minute show, where we're doing these days quick and punchy. Take care, guys, and we will see you soon. Bye-bye.